IndusInd Bank will kick off the earnings season for the banking names today. Given that there is no dearth of troubles in the country's financial space, Shraddha has put together the pulls and pressures that will drive the Q2 earnings for the BFSI space. Shraddha, what are we watching out for? Good morning.
Good morning, Neeraj. So, of course, no big surprises expected in this quarter because the large part of the negative developments, especially with respect to IL&FS, which did take place, will impact or reflect only in the third quarter. So, the good news here is that the systemic credit growth did improve or recover to about 12-13% in Q2. Of course, a large part of that will be benefiting private banks in terms of expanded market shares, and they will continue to show steady growth momentum. More importantly, when it comes to asset quality, that in the second quarter is unlikely to worsen. I'm not saying that about Q3, but in Q2 it is expected to not see any sort of further deterioration. A large part of the recognition has already been done, and hence you should see slippages moderating from the levels that we had seen in Q1. And again, a large part of those slippages also will be coming in from the watch list. That's the expectation. Sadly, as far as recoveries are concerned, we did see a sharp one-off jump in the recovery in Q1, but because of the absence of any major resolutions of large accounts in the second quarter, that support from recoveries may not be there. In our conversations with Canara Bank also, they had said that recoveries are anticipated to be lower than previously expected for Q2, and even the impact of big accounts like Essar Steel is estimated to flow only in Q3. Now coming to the most important part, which is the IL&FS exposure, it's the small PSU banks which have a larger exposure to IL&FS. So while they may not be NPAs as of 30th September and they will be classified as standard on the books, conservative banks may choose to make some provisions against the exposures to IL&FS group. Having said that, banks will have to make or take a hit, MTM hit with respect to the exposure to IL&FS papers, if at all. When it comes to margins, more or less they're expected to remain broadly steady on a Q-on-Q basis. Why? One, because while cost of funds have continued to rise in the second quarter, on the other hand, you will see the impact of the MCLR hikes that were previously taken. They will start reflecting. There's always a lag in the MCLR hikes which is taken. Also in Q1, net interest margins did see some big support coming from those one-off recoveries which will be absent now. PSU banks will continue to be impacted by slower growth with respect to their margin and the impact on that, but the NPL reduction could provide some support there. So largely, all in all, earnings growth could remain under pressure. Why? Two big reasons. One, because other income could remain under pressure because of that MTM hit on the bond losses that banks will have to take. Bond yields have risen about 11 basis points in this quarter as compared to 56 basis points in the previous quarter. So not a very big incremental hit. But having said that, a lot of banks had deferred MTM provisions because they had used the RBI dispensation. So again, they will have to account for that. And secondly, asset quality may not worsen, but credit costs will continue to remain at elevated levels. One, because of aging of the bad loans, and second, like in the previous quarter where we saw banks had continued to make efforts to improve their coverage ratio. So both of those things will weigh on the bank's earnings. So overall, when it comes to certain banks, they will be impacted by Kerala floods. So you have Federal Bank, South Indian Bank. When it comes to mid-sized private banks, they will of course continue to outperform and show superior PAT growth performance to the likes of Yes Bank, IndusInd Bank, RBL Bank. Corporate focused banks will see some improvement over the previous quarter, but again, revenue and earnings growth could remain on the softer side, and PSU banks are expected to remain report modest profits, with the exception of PNB, which is expected to report a loss.
Yeah, not unexpected at all. But Shraddha, so one is what the delivery will happen. Two, I think a lot of stocks will probably react more on the commentary from the management as well. What should one watch out for?
Right, so 5 points that I've drawn up, Neeraj. One is, of course, what happens with respect to the resolution of the stress power assets, because that remains a key overhang, especially for those corporate banks. Second is the commentary with respect to the impact of IL&FS default and the loss given default, the LGD as it is called. The quality of the NBFC's exposure, if the banks have stopped or brought down their lending to certain NBFCs, and if there is any stress there, will also be key to watch out for. Trends in overseas business growth and asset quality, especially in the wake of sharp rupee depreciation, is another thing to watch out for. And in terms of specific banks, of course, for Yes Bank and Kotak Bank, details on transition plans and guidance will be amongst the key things to watch out for. But largely, trends from Q1 should continue. If any big difference, we will see it only in Q3.
Okay, interesting. Thanks a lot for that, Shraddha. So that's what's to be watched out for. Of course, we'll talk about the one banking name, small finance bank that came out with numbers a bit later on and tell you what is to be expected from AU Small Finance Bank, but that's a bit later on.